Good afternoon, ladies and gentlemen, and welcome to the MP Evans Interim Results Investor Presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd also like to remind you that this presentation is being recorded. Before we begin, I'd like to submit the following poll. And I'd now like to hand over to Peter Hasley-Chaplin, Chairman of MP Evans. Good afternoon.
Thank you very much, Mark, and welcome, ladies and gentlemen. Thank you very much for tearing yourselves away from this sunny afternoon. We're doing our best to emulate the tropics, which sadly we can't visit at the moment for obvious reasons. But we're hosting this from our Tunbridge Wells office, and this is our first IMC event, and we're delighted to welcome you. So this is in following our interim results, which were released yesterday, and what we plan to do is to take you through our presentation, which is you will see on the screen. It's available also on our website, as indeed is our interim report. And for those of you who are shareholders, you will be receiving this, the hard copy, very shortly in the next day or two. Of course, a number of you are not shareholders. There'll be quite a few who know very little about the company. So we're going to assume on this occasion a relatively low knowledge base and take you through slowly, giving you a little bit of background. I'm going to kick off the presentation with a few background comments, a bit of an overview, and then I will hand over to Tristan Price, our Chief Executive, who will talk about, first of all, the market, the palm oil market, and he will also talk a bit later about the operational aspects of the business. And Matthew Coulson, who's our Finance Director, will talk about the results themselves and about the financial aspects of the group, and then I will briefly wind up at the end. So without further ado, let us make a start on the presentation. Going to the slide, who we are. Well, we've been around a long time. We're a 150-year-old or so plantation company, started in the 1870s with our origins going back to tea in Ceylon as it was then, and rubber in Malaya as it was then. But cutting a long story short, in the last 10 or 15 years or so, our strategic focus has increasingly been on sustainable, and that's a very important part of our business, sustainable Indonesian palm oil, and that's where our major growth has been in recent years. We have an established track record of both growth and financial returns. It's perhaps of interest to note that in the last 25 years or more, we have maintained or indeed increased our dividend each year. We have not cut it. You'll see from the map that we have a number of different plantations in Indonesia. I won't go through them individually, but there are 3 in the northern part of Sumatra, one of which is a minority-held interest of a relatively small plantation, Kerasan. The other ones are all majority-owned, and those represent our older, more mature plantations that have been held in the group for many years. The other plantations, Bangka, just off the coast of South Sumatra, and the Musi Rawas project in the southern part of Sumatra, have been developed in the last 10 or 15 years, Musi Rawas most recently. And then we have 2 new projects in Kalimantan, the Kota Bangun project and then to the northeast of that, the Bumi project, which is also relatively new. But each of these has been from the start sustainably managed. We have an increasing reputation for operational excellence, and we have a strong balance sheet. Our gearing has gone up a little bit, but by most companies' standards, we have a very strong balance sheet and relatively low gearing, which will enable the continuing capital expenditure that Matthew will talk about, and indeed possible further acquisitions. Due to the substantial plantings in the last 10 to 15 years, the average age of our oil palms is very young compared to most plantation companies. And these represent a rather exciting foundation for future crop growth in the next decade or so. We have an attractive earnings profile, and yet we seem to trade at quite a significant discount to our peers, our plantation peers in Asia, for reasons which are not entirely explainable. Perhaps because the plantation sector there gets more coverage because there are many more plantation companies there. Turning to the next slide, we have always been sensitive to issues surrounding sustainability, but this has been formalized through, in the early 2000s, soon after the Roundtable for Sustainable Palm Oil, the so-called RSPO, was formed. We became members of this early on. And then much more recently, in January of this year, we produced our first sustainability report. And there are three main pillars to this, and indeed to our approach on sustainability in general. The first of these is to protect the environment, reduce, minimize greenhouse gas emissions, to protect the forests. There's no question of us clearing forests or anything remotely resembling forest. If we develop any new areas, these would be just scrubby wasteland areas, or indeed in the case of Musirawas, our most recent acquisition, this is largely an ex-rubber plantation area, so we're felling one crop in favour of another crop. In terms of our production itself, this is wholly in line with RSPO guidelines. For instance, on such a key thing as water, we ensure there are no pollutants, there's no water from our mills, and no effluent going out into the river systems. And our oil palm and palm oil is fully traceable from both our group, that's our own majority-owned plantations, and from those smallholder projects which are attached to our new projects, which Tristan will talk a little bit more about later. All this produce is fully traceable. Talking of the of these local smallholder projects, this engenders a lot of goodwill, and it's an example of how important it is to engender goodwill vis-a-vis the local communities where we operate. Without the local communities, the local villagers' support, we would be unable to operate. So this is vital, and we pride ourselves on the excellent relations that we have with our local communities. Again, Tristan will talk more about that in a moment. We, of course, have a fair approach to labour and to our workforce, which we may touch on also a bit later. Just now, we're taking a snapshot of where we stand in numbers. This is as at the end of 2019. We've been growing rapidly in the last number of years, and we will continue to grow. But where we stood at the end of 2019 was that we had 39,200 planted hectares of our own group oil palm. We had 12,200 planted hectares of those smallholder schemes I mentioned before attached to our newer group oil palm estates. We have largely planted up the land bank that we've acquired over the last number of years. It's more or less fully planted, but we have probably just over another couple of thousand hectares to go, and these are almost exclusively at the Musi Rawas project in the southern part of Sumatra. And this has been paused for reasons, again, which Tristan will explain, but we're hoping will be resumed shortly so that we can complete the planting out of the land bank that we currently own. But it doesn't mean there won't be some possibilities to acquire more land in due course. We have just over 6,000 employees. We had in 2019 a revenue of just under $120 million, and the operating profit for the year was $16 million. Following the continued increase in crops and CPO production and our operating profit for the first half of $6 million compared to last year of $1 million, the board has maintained the dividend, the interim dividend that we are paying of 5 pence per share. This follows on from the maintained final dividend last year of 12.75 pence. As I just mentioned, it is our intention to continue at least to maintain annual dividends and where possible to increase them. And we hope that will be possible as income levels continue to rise in the future. So let me now pass across to Tristan to talk about the market side of palm oil.
Yes, indeed. Well, good afternoon. There are 3 slides in this part of our presentation that deal in turn with the price of CPO, perhaps the factors, secondly, that underlie the supply of vegetable oils, including CPO, and thirdly, on the demand side, what's been happening to the world demand for vegetable oil. But looking first at this slide, which illustrates what's happened to the price of CPO in the recent past, you can see very clearly how after a period of weakness through 2019, that towards the end of that year, the price rose quite sharply. That was in response to a tightness in supply of world vegetable oils, including palm oil, combined with good demand, particularly in Asia, and a reduction in the level of world stocks. Those factors combined to lead to quite a rise in price towards the end of 2019. And indeed, the price went back above its long-term average and looked fair set into 2020 and beyond, a sort of an upswing in the commodity price cycle. Of course, it then ran immediately into COVID-19, and with the pandemic, the demand side of that balance altered very dramatically, and the price, of course, fell as production and demand worldwide in many different areas fell sharply. What's quite noticeable, though, is that clearly Asia was where the COVID pandemic started, but it was also the place where the first signs of a revival were noticeable. And quite quickly, as demand began to recover and trade began to recover, the price turned up. And when it did turn up, it turned up quite sharply. There was a sense that it had gone too far on the way down. And following the end of the interim period that we're discussing, that the price has continued to strengthen and has resulted in a CPO price today of well above $700 per ton in Rotterdam, and quite firm at that price. It's expected to stay at or at around this level, certainly through to the end of this year and well into next year. Looking slightly more closely at the supply side, it's worth, I think, looking again at why we had experienced a downswing in the price. And that resulted from 2 years there, in 2017 and 2018, where there was excess supply of vegetable oils more widely. So not only palm oil, but also soybean oil and the other vegetable oils showed strong growth in supply. That glut of vegetable oil availability meant that, unsurprisingly, the prices for all of those oils was quite weak. 2019 was a turning point. Not only did palm oil growth shrink significantly, but the production of other vegetable oils actually fell. And it was that was the background to the increase in price towards the end of 2019. And that tightness of supply was expected to persist into 2020. And indeed, there's nothing about COVID directly that affects that supply situation. If anything, there's been an increase of the sense that palm oil growth is worse than expected, on the basis that a lot of Malaysian palm oil is harvested by non-Malaysians, and that the travel restrictions imposed as a result of managing COVID-19 has meant that the availability of labour on plantations has reduced and made it difficult in Malaysia for them to harvest their fruit. Thinking about demand, this slide shows how resilient the increase in demand for vegetable oil more widely has been. It ticks along between 2 and 4%, very regularly, at an average, I would say, of not much less than 4%. And we expect it to be resilient too in response to the pandemic. Certainly as a basic food, the demand in Asia has been reviving, and we expect that trend to continue. There is a question about how quickly the roughly 10% of palm oil that goes into the production of biodiesel, so palm oil as a fuel, how quickly that sector of the market will recover. But the Indonesian government has a program to increase the use of palm biodiesel, and is very committed to that program. Has over the last months has made it very clear that it not only wants to execute that program, but wants to push on and actually develop even greater proportions of its transport fuel as biodiesel. So even in that sector, there is a sense that there is a demand that will revive, underpinning the demand for crude palm oil. At that point, I think I'd like to hand over to Matthew to talk about the interim results themselves.
Great, thank you, Tristan, and good afternoon, everyone. So as Tristan says, time to look at the results themselves for the first half of 2020. And as you can see there, the story for the first half is one of significant increases across the board. So let's start with the top line. Let's start with revenue. And as you can see there, revenue up by more than 60% in the first half of the year. Now, I always like to say that determining our revenue is fundamentally a pretty straightforward exercise. It's a case of taking the production that we achieve, the CPO, the crude palm oil production that we achieve, and multiplying it by the average price that we achieve for that oil. And as you can see, both were up significantly in the first half of 2020. So production up by more than 30%. And then whilst, as we saw on one of those previous slides, there was some volatility in CPO pricing in the first half of the year, on average, the price was up 23% compared to the first half of 2019. So the average price, CIF Rotterdam, for the first half of the year was just under $650 per tonne. And you take those two together, and that's what drives the more than 60% increase in revenue. So where we achieved $46 million of revenue in the first half of 2019, so we achieved more than $75 million of revenue in the first half of this year. And it's really the increase in price that then determines the rest of the income statement. And as you can see, a significant increase in gross profit. So gross profit was $2 million in the first half of 2019, up substantially to just under $9 million for the first half of 2020. an increase in margin overall from 5% to 12%. And important to note that our production costs per tonne stayed level at $385 in the first half of the year. And that's production cost per tonne for areas where we have our own milling facilities. This all feeds down the income statement, and you can see the impact on operating profit. So operating profit that was 1 million in the first half of last year becomes 6 million in the first half of 2020. So moving on, and I guess one other income statement point to make relates to tax, an important point to be aware of. So in the first half of this year, the Indonesian government announced a reduction in the headline rate of corporation tax, where for a number of years, the headline rate of tax in Indonesia has been 25%. They announced that in 2020, the rate would fall to 22%, and then it'd fall again in 2021 to 20%. So very good news for us, given where we generate our profit. And as you can see, our total tax charge for the first half of the year was under $1 million. Moving on to look at the balance sheet, important to note the position with regard to net debt. A very small increase in net debt in the first half of the year. So net debt at $85 million at the end of the first half, just as I say, a very small increase, and gross debt at $97 million. Important to note that if we make the assumption that CPO prices continue at or around a $700 per tonne level, and I think as you can see from the previous chart, we don't think that's a particularly unreasonable assumption to take. But if we make that assumption, then actually net debt peaks during the current year, peaks around now, based on our current investment programme, and we would expect to see net debt really starting to fall quite significantly from 2021 onwards. One thing that particularly helps that, of course, is the disposal that we announced just after the end of the first half of the year. So we announced in July that we'd agreed to sell some land in Malaysia, our Bertam estate land, around 70 hectares, for over $20 million, and we expect to be receiving that proceeds over the course of the next couple of years. Final points to note on cash generation. We continue to be absolutely cash generative, and you can see the figures on the slide there, and that supports our capital investment programme. You can see that we've invested more than $16 million in the first half of the year, and we continue to invest in our ongoing programme of capital investment. And we'll talk some more about that in a few minutes, and a very important programme we've got to complete around our existing plantations to make sure that we've built out everything that we need to do. But at that point, I'll pass back to Tristan to talk some more about our operations.
Thank you, Matthew. Starting a look at the operations, I think the right place to begin is with crops, because crops continue to be on an upward growth path. That's a result of the planting that's been carried out over the last more than 10 years, and results from not only increasing areas being brought into maturity for the first time, but the increasing yield as the palms age. Palms have a very strongly increasing yield from when they are first brought into maturity or into production, and at about 3 years old after they're planted. And that rises very strongly then to when they're about 9 or 10 years old, where they reach their peak production, and then maintain that over the next sort of eight or 9 years before the yield gradually falls. So we're benefiting from two things in the planting that we've done. We're benefiting from more area that's mature, and we're benefiting from this very strongly upward trend in the yield on the younger palms. As a result, the fresh fruit bunch crop in our own areas was 16% higher than in the first half of 2019, as it was in the scheme smallholder areas. These are smallholder areas that are attached to our projects, where the smallholders form a cooperative. that asks us to plant the land on their behalf and to manage the land on their behalf. And they then benefit from the revenue, because the fruit from those cooperatives is sold back to us for milling at a government supervised price. So those were up by 16%, but there was then a dramatic increase also in fruit bought from independent smallholders and third parties. And we took a conscious decision in the middle of 2019 to buy more fruit from these sources in order to use up spare capacity in our mills. As a result, the total crop that we actually had for processing increased by 34%. But the engine room of the growth in our areas is the projects at Bumi Mas and Musi Rawas, which are growing extremely strongly. The older projects at Bangka and Kota Bangun didn't produce so much crop during the first half of this year due to a dry spell in 2019 that affected both areas. Not so seriously in Kota Bangun, where it definitely fell within the sort of a normal range of weather variability, and indeed the rains duly returned and crop has begun to swing up again through. We're expecting the third quarter to be an improvement, and the fourth quarter a significant improvement. The effect in Bangka is going to last a little bit longer because the dry spell is a little bit more prolonged, and therefore the recovery period is a little bit more prolonged too. We think over time, Bangka produces the sort of crop we would hope for it, because after a dry spell, you tend to get a period of super productivity as the palms in some senses catch up with the periods where they were semi-dormant. That means that over time, the crop is on average what you would want, but in individual years, or indeed, as we're talking about now, individual 6-month periods, the crop can be a bit more variable. Unsurprisingly, that increase in crop has led to a strong increase in production, a 31% increase in production of crude palm oil to 125,000 tonnes. And that's because we continue to get very good extraction rates. On average, they were 23.5% for the group's 3 mills. And that was only a touch lower, a tenth of a percentage point lower than the same period last year. And that was despite taking in these significant volumes of crop from outsiders that's not the same quality as our own crop. That was particularly seen at Pankatan, and you can see in the relevant tables of the interim report how its extraction rate fell from 23.1 to 22.6 as a very significant increase of independent smallholder fruit came into the mill. In terms of costs in the operational area, they were the same in the first half of 2020 as they had been in the first half of 2019. And as last year, we would expect the cost to fall through the second half of the year. That's because some of the costs that we incur fall earlier in the year, and so the effect of that is eventually spread out through the year. It's a timing point. But also because the crop in the second half of the year tends to be slightly higher than in the first half of the year. So again, that helps the unit cost in terms of looking at the year as a whole. We have for some time now been experiencing falling unit costs, and we're making the point that after a long period of falling unit cost, we are now approaching the point where the effects of extra volume that are extremely helpful when looking at that will no longer outweigh the natural inflationary pressures that you experience in any productive operation, wages increases and the increase in price of other inputs that we need. A final point on costs is that at $385 per tonne of palm product, we're quoting an extremely full cost measure that reflects all of the costs of our regional office in Jakarta, as well as the 3 sub-regional offices, small sub-regional offices that we have. It really incorporates all of our local costs. And it's a point to bear in mind if you're comparing MP Evans with other plantation companies. And if you look at the cash cost, then that's significantly lower than that rather full cost that you've just looked at, and is closer to below $300 a tonne, $280 per tonne palm product. And we do all of this in a sustainable manner. I think Peter's emphasised that we're a producer of sustainable Indonesian palm oil. And we wanted to explain why, if we're a producer of sustainable Indonesian palm oil, why only 53% of our oil is RSPO certified. And the reason for that is that the RSPO certifies mills. It doesn't certify hectarage. So whilst all of our hectarage is farmed in full compliance with the RSPO standards, we don't get a certificate to demonstrate that until we build mills into our areas. So as we build mills, that percentage will rise very sharply. We're also running a program to qualify independent smallholders as being RSPO certified, in line with a new standard published by the RSPO at the end of last year. Overall, we have an objective to reach 100% certification, and we should be significantly on the way to that by the time we get to the end of 2023 and into 2024. A point we've made before, but we're a zero waste operation. We use our empty bunches and we use them to create compost, which reduces our need for inorganic fertilizers. And we capture methane from our mill effluent and use that to generate electricity that we use to power our own operations, and also sell surplus electricity to the Indonesian power grid. On the social side, we have extremely strong relationships with our local communities, not least through those smallholder cooperative schemes, but also in the provision of facilities that are not only for staff and workers, but such as sporting facilities or clinics and schools. We invest in training of our own staff, and to some extent also in the local communities where we operate. And we make sure that there's good progression for our local staff within our Indonesian operations. The last point on sustainability I wanted to address was that we have paused planting at Musirawas in response to an improvement, a change in RSPO standards that took place right at the end of 2018. It was clarified at about Easter 2019 that those changes, those upgrading that had taken place to the RSPO standards was to be applied retrospectively. So whilst we had been developing Musirawas in full compliance with the RSPO standards, we paused and spent the time to demonstrate that our planting there was also in compliance with the new upgraded RSPO standard. We have put together all of the necessary paperwork for that and submitted it to the RSPO, and we're now waiting for the green light from them to continue with the planting there. We believe we're going to be able to plant everything that we expected on that project, because it is essentially replacing an old rubber project with oil palm, so replacing a crop with a crop. This is a view of what the future may look like. I think here we have a chart of the crop that has come off our areas since the new projects really began to produce crop. And it shows that strong growth with the memory of the severe El Nino in 2015-16. Now a memory as growth has returned to its path, and shows how we expect to reach the million-tonne mark in 2021 and carry on growing at that point up to the end of the 2020s. And I should emphasise that this is from palms that are already planted. These are from our existing areas and palms already planted, with the small exception of that conclusion to the planting in Musirawas, which we do assume takes place. But other than that, this is from existing projects. Should we take on any other areas, that would be in addition to the picture that you see there. And a final word from me is about our capital spending and our building of new mills. Clearly, all of that crop that turned into production also requires milling. And the mills allow us to extract the absolute maximum value from our fruit. Not only that, but it gives us the opportunity also to fill up any spare capacity with third-party fresh fruit bunches. We have 3 mills. We have them at Pangkatan in North Sumatra, on Bangka, and 1 mill at Kota Bangun in East Kalimantan. But today is a very propitious day in that the second mill in Kota Bangun actually began commissioning earlier today in the morning in Indonesia. And so that would be our 4th mill. And we are already well underway in terms of constructing our mill at Bumi Mas. The groundworks are complete, the civil works have begun, and fabrication of the mill is already well underway in different factories in Indonesia and Malaysia. That is expected to come into commission in the middle of next year, although we accept there is a risk, given the travel restrictions imposed to manage COVID-19, that may slip. But after that, we have the 6th and final mill from the current developments, which we expect to build at Muzirawas, and that would begin in 2022 and finish in the second half of 2023. At that point, the development that started really in 2005 of the new projects at Bangka, at Kota Bangun, and Muzirawas, and in Bumi Mas would be complete. And after the spending of the 60 million, which is largely on those mills that we just talked about, that would really bring our capital spending program to a conclusion, and therefore, just at the point where the crop is continuing to grow, as we saw above, would produce a significant amount of free cash flow for the group to invest in further areas and to distribute to its shareholders. So at that point, I'd like to hand back to Peter, who has some comments to conclude.
Thank you very much, Tristan. So let me just make a few comments about the key aspects, I suppose, of our business. First of all, it is the focus on majority-owned Indonesian plantations producing sustainable palm oil. We have a strong balance sheet, which will enable our planning for continued expansion. So this will allow us to complete our capital expenditure program that Matthew has referred to, and the potential for some further acquisition as well. We are extracting the maximum value from our Malaysian property assets. As Matthew touched on, we have entered into an agreement to sell Bertam Estate into Bertam Properties, and of course we own a 40% share of Bertam Properties. We'll be taking net proceeds of over 21 million from that sale, but Bertam Properties will in turn develop the land that has been bought from ourselves and turn that into housing and other commercial developments, and in turn make that into profitable transactions. And we will, as we've done for the last 25 years or so since we first sold the land to Bertam Properties, take our share of the dividends from Bertam Properties as they continue to develop and sell the remaining parcels of land. We can look forward to significant increase in crop and revenue from our existing plantations right through to the end of the 2020s. We can also look forward to increasing dividends alongside yields with capital growth. So exciting prospects for the next decade or so. And indeed, we continue to have confidence in the prospects for palm oil, both in the shorter and the longer term. So that concludes our presentation. A number of you have very kindly submitted some questions. There were 8 or 9 which were submitted before the start of this presentation. And I see there have been 1 or 2 which have come in during the course of it. We'll do our best to answer as many as we can. We'll start with those that have been submitted in advance. But first, may I say thank you so much to all of you for kindly submitting them. That's much appreciated, and some interesting questions. Mark, I think I hand back to you briefly.
That's very kind of you, Peter. Thank you so much. Could I just remind ladies and gentlemen to continue to submit questions using the Q&A tab situated on the top right-hand corner of your screen. You simply type in the box at the bottom and press send. But just while the company take a few moments to review investor questions submitted, and before we enter into the Q&A, I'd like to remind you that a recording of this presentation, along with a copy of the slides, and the published Q&A will be accessed via your Investor Meet Company dashboard. Investor feedback is also important to the company, and immediately post this presentation, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. So I guess we've had, as you said, a number of questions. I will couple 2 of these together because they are both a very similar nature. The first question is, with your new mills coming on this year and next, what capacity of your own crop can you process? And how beneficial is processing yourself? And the other question, I guess, around capacity is, which palm oil mill are you building first, Bumi Mas or Musi Rawas? Are you able to quantify the benefit of the latest palm oil mill to complete will have, apart from enabling a bigger amount of our palm oil production to be certified as sustainable produce? What is the scheduled completion date for the other mill?
Fine, well, I'll take that one. I think we concluded the presentation with a little piece on the mill. So just to reiterate that the second Cotabangam mill is being completed right now. We expect the Bumi Mas mill, which is next, to be completed in the middle of next year, and the Musi Rawas mill to be completed in the second half of 2023. So that would bring us to 6 mills. And the benefits of processing ourselves are primarily to get better margin. I think we do declare in the interim report, we show what sort of an oil extraction you're paid for if you sell your fruit. The way the contract works is the miller will give you an assumed rate of oil extraction for your fruit. And that is around 20% generally. Now, we know we have excellent fruit, and we could expect to get extraction rates of 25% and more from our own fruit. So the difference is what we're giving away to the third-party mill. So that the primary reason is to improve margin by getting the maximum value, the maximum oil, literally squeeze the maximum out of our own fruit. But there's also a strategic point in that fresh fruit bunches are perishable, so that if you don't mill your own fresh fruit bunches, you lose some market power. Anybody who is buying from somebody who has a perishable good can make themselves vulnerable, particularly in remoter areas where there may not be strong competition to take the fruit from you. So those are the benefits, and clearly there is the benefit on sustainability too, but primarily this is about margin, and it's about capturing the maximum value that we can from the fruit that we produce. I think within that question there was a point about well, how much of your own fruit are you going to be able to process? And the answer is, I hope you realise that by the time we get to 2023, it should be 100%, because that's the purpose of building these mills. But by 2022, we should, before we build the Musi Rawas mill, we should be up at sort of the mid-80s%, I would think, of our total production.
Thank you very much. The following question we have is, what are the catalyst/levers available to increase production outside maturity of the crop?
I think there are three points on that. There are ways. I think the first one is about operational excellence. So it's about making sure that you get the most from the crop that you have. Partly you want to maximize the crop itself. So that's about making sure that the field conditions are good, that the road network is excellent, so that allows you to put the fertilizer in to make sure that the fertilizer is applied properly and in the right quantities, so that you're actually getting the palms to produce at the maximum that they can. I think there's also something around making sure that you harvest them at the right moment. There's quite a big difference between harvesting overripe or underripe fruit and harvesting it at the right point. So that again is about harvesting discipline. It's about having enough harvesters. It's about making sure that they come around frequently enough, and therefore that you're harvesting your fresh fruit bunches at the optimum point.
Thank you.
Hang on, I got to my points 2 and 3, but they're quick. But the road network is key, because the road network helps you to evacuate your fruit and get it to the mill. If you can't run your trucks over the road network in wet weather, then you can't evacuate your fruit and get it to the mill. So it's about operational excellence, firstly. Secondly, an obvious point perhaps, but you can actually just buy independent smallholder fruit. So if you're not generating all of the fruit yourself that you need to fill your mill, you can add to it by buying independent smallholder fruit, and that increases your CPO production. The last strategy would be to buy additional pieces of land where you have spare capacity. You could then buy additional land with a view to using the output from that to feed your mill. So those are the 3 points, I would say. Operational excellence, lots of points of detail, but repeatedly. Buy outside fruit or buy new land.
Thank you. The next question, rather lengthy in nature, so just bear with me. Palm oil prices in recent years seem to have spent lengthy periods below the monthly 10-year average price of $790, quoted in the 2019 REA annual report, perhaps due to, with the benefit of hindsight, excessive supply. Do you now think we are due a period of palm oil prices staying above that price for a lengthy period, if only to maintain the average? Are there too many variables involved in making forecasting palm oil prices anything but a mug's game? Is the backwardation on the futures market anything to be concerned about?
Thank you. Well, I think the long-term average price has been falling a bit. I mean, we would obviously be delighted if it were a fixed thing, and we could look forward to a prolonged period of prices at higher than that level. I think what it does demonstrate is that we've been through a downswing in the commodity price cycle that I talked a little bit about in the piece on the market earlier. So we do feel that we could expect an upswing in the price. I wouldn't like to say exactly where that will go or how long it will stay, but we do feel we're in an up phase of that. In terms of how easy is it to forecast the CPO price, I would say a mug's game is possibly the right conclusion, because you can't forecast the CPO market in isolation. You also have to look at the competing vegetable oils. So you're immediately looking at forecasting not only CPO, for which there is famously patchy data, notably for Indonesia, but you also have to look at the other major vegetable oils, soybean oil, rapeseed oil, sunflower seed oil, and you have to take a view about all of those, and you have to take a view about transport costs, and to some extent also tariff and trade considerations before seeing where that all comes out. I think it's an extremely difficult thing to do. In terms of backwardation, I don't think that's something that's a matter of concern. I think people, given all of the uncertainties around the future path of supply of vegetable oils, will tend to be cautious in terms of the future prices. But in the short term, particularly crude palm oil refineries have to run at capacity for them to be viable. And so if you're short in the feedstock immediately, that can lead to short-term price increases just in order to be able to get hold of the material that you need. So I mean, I don't think it's something that's something that people should be concerned about.
Thank you. Next question. Given the Indonesian government's expressed intention to alter the export tax on palm oil to take in more revenues, and the effect that this has subsidizing the downstream processing industry for palm-derived products, are you not tempted to move into this area, if only to recover some value from the export levy and the export tax paid, or from the revenue foregone from not exporting? What are the minimum capital requirements for moving into this area?
Perhaps if I can respond to this question. Certainly moving downstream and particularly into refining is something that the group has previously investigated, particularly on the question about capital requirements. The minimum capital requirement for moving into refining is somewhere in the order of $20 million. But I think perhaps more importantly, it's the minimum input of CPO for refining that is key here. And in order to run a refinery, we would estimate that it's in excess of 150,000 tonnes per annum of CPO that would be required as input to the refinery. Now, whilst we do produce more than that per annum as a group total, it's our geographical diversity across Sumatra and East Kalimantan that would work against us in terms of being able to run a refinery. So it wouldn't make sense for us at the current time to move downstream. Clearly, it's something that we could continue to keep under review as the group continues to expand, but it's not something for us right now.
Thank you. Given some 5.5 tonnes of CPO per mature hectare, producers of palm oil struggle to turn a profit at the operating level. Do you think the Indonesian government has the balance of taxation right on palm oil producers, taking into account the export levy, the export tax, the corporate rate of tax, and the 5-year time limit on losses carried forward regime?
I guess, first of all, on this question, just an observation. There's a sort of statement at the beginning saying that some producers who are achieving 5.5 tonnes of oil per hectare are struggling to achieve an operating profit. Perhaps those producers need to take a careful look at their cost base to see why that is, first of all. But just an observation on the assertion in the question. But I guess really the question is a tax question, isn't it? So on the tax point, I guess I'd make two key observations. First of all, in the presentation, I'd mentioned the fact that the corporation tax rate in Indonesia is falling, coming down from 25% to 20% over a couple of years. And of course, as I said, that's something we very much welcome. I think the other point to note, and it's been highlighted in the question, is that the 5-year time limit on carrying forward losses. Of course, that's different to the approach in the UK, where there is the option to carry forward effectively indefinitely. And yes, that does create some challenges in a long-term business like oil palm. So I think that was a fair observation built into the question.
Thank you very much. Given most palm oil producers at present don't have an ROC of 11%, and given Rupiah bank interest charges are about 11%, do you feel the Indonesian government realises its own fiscal policy is hurting debt-funded palm oil producers?
Okay, on this question, first of all, clearly high interest rates are a barrier to investment across all sectors, not just an individual one. And again, I can't comment on other producers, but if I look at our own case, then we're not entirely debt funded, as I'm sure has come across in our presentation. We have relatively what we would consider modest levels of debt. And I think the other critical point to note is the debt that we do have is not rupiah denominated. We have US dollar borrowings, and our US dollar borrowings are at substantially lower interest rates than the 11% referred to in the question.
Thank you very much. We've got two final questions before we have a look, I guess, at those ones submitted today. And I'm obviously mindful of the time as well. So the next question is, just as a matter of interest, and it's not very important, but what are the typical CapEx requirements for a 5,000 hectare estate planted up from seed until it becomes cash flow positive? And at what tree age does this occur at? Assuming a sustainable long-term ex-Millgate palm oil price of $610, like the one used in the Kong Jaffa evaluation report, what does an ex-Millgate price of $610 translate to when expressed as a CIF Rotterdam price?
Okay, so there are a few sort of separate questions here. I'll try and pick them all up. Firstly, on the cost of development. Development costs can be very sensitive to land compensation costs, but we would broadly expect cost of development to be in an $8,000 to $10,000 per hectare range, so somewhere of that order. There would be a further cost for building a mill to service an estate. Mill cost, say, $15 to $18 million. We wouldn't necessarily expect to build a mill at that expense. For a 5,000 hectare project, we would think of that more to support a 10,000 hectare project. So you would then think about spreading that, say, of $1,500 per hectare across a 10,000 hectare project. Within the question, there was a point about at what point does the project become cash flow generative? Again, that depends. Critically, it would depend upon the rate of planting of the project, but as a rule of thumb, we would think somewhere around year 6 to give an indication. And I think the final part of the question related to the relationship between Millgate prices and CIF Rotterdam prices. To give us a rule of thumb, at current prices, we would think of a difference of around $100 per tonne, made up of the export levy and made up of freight and insurance charges, so around 100. The difference would go up a little bit as prices increase, as the export tax starts to kick in on a progressive basis as prices go up. But based on current prices, think of a rule of thumb of around $100 difference.
That's brilliant, thank you. And finally, can you talk a bit about the Penang property market and what effect lockdown is having?
Perhaps I'll take this last question. Well, like property markets across the entire world, I think it's certainly been affected by the lockdown situation, both in Malaysia and in Penang specifically. Although having said that, Penang has always been an affluent part of Malaysia, and the effect in Penang, I think, is less severe than in other parts of Malaysia. There are apparently some stimulus measures which are going to come into play to help to assist the property market, such as a freeze on stamp duties and measures such as that, which are likely to come into force next year. But in the meantime, we, of course, as we've touched on earlier, we agreed the sale of Bertam Estate to Bertam Properties, and that was agreed prior to the start of the lockdown. It was actually formalised afterwards, so that that deal remained intact. As far as Bertam Properties itself is concerned, actually, although the top end of the market has been quite significantly affected, further down the line, I understand that the lower to medium cost housing, there's still quite good interest in, quite good demand for, values of sort of 500, 600,000 ringgits and below. That's the sort of 100 to 125,000 pounds level and below. There's still good interest there. So that's looking cautiously encouraging there. Now, I don't know, Mark, how our time stands. I can see that. I mean, thank you very much for the further questions which have come through. do we have time to answer some or any of these?
Yes, of course. So perhaps, obviously, I know you haven't had a long time to look at these questions, particularly the more recent ones that have come through, but perhaps if you want to select a few of those. And of course, just to remind investors that all the questions submitted today will be reviewed by the company, and of course, responses will be published where it's appropriate to do so. So if I could perhaps just hand back to you, and if I could ask you just to read the question as well as give your response, just on the basis that investors can't see other investor questions. Thank you.
Of course. Well, I think, as you suggest, we'll try and pick up a few of these and answer them straight away. The first question is, in 2016, you guesstimated the net asset value at £11. Can you make an update? So I think, Matthew, perhaps could you make an update?
Yes, certainly. So you're quite right that we did make an estimate of net asset value at that time, around £11 per share. We have been providing annual updates of that net asset value per share each year in our annual report. The latest update was in our 2019 annual report. It continues to be a similar figure at around £11 per share, and we intend to continue updating that on a regular and an annual basis each year in the annual report.
Thank you. Perhaps the next question is, if the discount valuation persists, why not get at least a secondary listing on the Malaysian exchange? And picked on that one because it is something that we've discussed in the past, and either Malaysia or potentially in Singapore. But we've up to now concluded that there are significant costs and a regulatory burden associated with having a secondary listing, as well as consequences in the UK. I think so we understand that the company would immediately lose, or shareholders would immediately lose, access to business property relief. And we're conscious that some people hold the shares in inheritance tax funds, so that they would lose that benefit. And we do live in a world where it is extremely straightforward to buy shares in foreign countries on stock exchanges. So I think our feeling is that the right approach to that is to make people in Asian markets more aware of us, and that the opportunity that they have to acquire shares on the London Stock Exchange. There's a point here that I think has come up in discussion with institutional investors, and therefore I think it's very appropriate to discuss it now, which is, how is it that margin has not risen more in a year when the average price rose 23%? So Matthew, perhaps you could
Yeah, absolutely. And I think this is very much connected to some of the things we've been talking about earlier and in the presentation. As we discussed, when we look at crop and we look at production, you will have seen that there's been a substantial increase in crop and production arising from our two youngest and our two newest locations, namely Bumimas and Musirawas. And in particular, that in those two locations, we are working to build our own milling facilities. And that once those milling facilities have been developed, we will access the higher margins in those locations. So really what we are seeing in the short term is something of a mix variance, where because we are not yet able to obtain the higher margins in those locations, we get that short-term mix effect. That will go away as we build out our milling capabilities.
Thank you, Matthew. I think maybe a question I could invite Peter to answer, which is, how big is the company in comparison to other palm oil producers in the area?
Well, I mean, there are any number of different sizes of entity operating in. I mean, by the area, I guess,
Southeast Asia,
sector.
Right? Southeast Asia. I mean, I think.
Yeah. We're very small, really. I mean, we're probably still less than 1% in terms of the total amount of palm oil that is produced. So if that gives some idea, we're minnows still. We have grown very substantially in the last number of years, from a relatively small base, from some 10, 15,000 hectares to over 50,000 hectares. But there are companies who have over 1 million hectares, the likes of Sime Darby in Malaysia and other one or two other big producers. But we don't really regard ourselves as competing with other producers. We're all in the same business, and in a sense, we're all in the market together alongside producers of other alternative vegetable oil crops. So if anything, we look to other palm oil companies, those that we know, to compare notes with, and we benefit from each other's observations and experiences.
Thank you. A question here about the mills, and will the future and 6th mill be financed through additional debt? Matthew, that's one for the finance team.
Absolutely, yes. And the answer to that question is that it will not be additional debt that finances the 5th and the 6th mills. Our existing facilities, alongside operating cash flows, are expected to be more than sufficient for financing the remaining capital expenditure programme.
There's a question here about expansion plans, and it says, a question on the group's upstream expansion plans. Would it be a brownfield or greenfield? And what is the planned CapEx fair price for the group? Well, I think in terms of the fair price for the group, I think Matthew addressed that in his answer to the valuation question. But in terms of the expansion plans, well, I think at the moment, as we said, we're looking at a period of consolidation, and we would look to increase perhaps incrementally, and that would likely be brownfield, either existing plantation land or existing plantation land with small opportunities for new planting. In future, it's difficult to say. I mean, we would only look at sites, whether they're brownfield or greenfield, that would be fully compliant with the Round Table for Sustainable Palm Oil standards. And we are conscious that in Indonesia there are significant opportunities that could be either brownfield or greenfield and would not in any way have negative implications for the biodiversity or forest cover in the country.
That's brilliant.
Can I just follow on from that question? There was a question a little earlier about whether we plan to grow organically.
I was just coming to that, actually.
Oh, okay. Shall I
anticipated?
I mean, what you've just said largely answers that, but just to add to it, perhaps.
Can I read the question?
Yeah.
Which is that, do you think growth will be predominantly organically or through acquisition, and what do you look for in potential acquisitions?
So as Tristan really has just touched on, I mean, we're not looking for any sort of major expansion at the moment, either by way of greenfields or brownfields. We've had a significant period of expansion in the last number of years, and we're more looking to consolidate right now. However, if there's one area where we would be interested to expand further, it's actually around our existing project at Kota Bangun. This is our biggest project, the one where we've just literally today commissioned our 2nd mill. It's just over 15,000 hectares. With the 2nd mill, we will continue to have surplus capacity. We need a 2nd mill, but ideally we would increase our hectareage by another 2,000-3,000 hectares, so that mill could be used to optimal utilization. And if we can acquire more hectareage in that particular area, then we would be very tempted to do that.
Good.
That's perfect.
I think we sort of made a selection of the
Thank you.
Of the questions that have come in during the presentation.
Definitely. Thank you very much, Tristan, Peter, and Matthew. As I say, I think you've addressed the questions, and just to remind investors, of course, all the questions will be reviewed and we will publish responses where it's appropriate to do so. Perhaps I could just hand back to you to wrap up. I know investor feedback is important to you, and for those investors on the call, obviously we'll be redirecting you post the final comment. So thank you.
Well, Mark, thank you. Thank you very much for hosting this for us. I hope everybody has found it useful and helpful in your understanding, whether you're an existing shareholder or somebody completely new to the palm oil business and to MP Evans itself. We hope we've given you some insights into those things, and we welcome any further questions that you might have. So feel free to be in touch with us. And on behalf of the three of us, may I say thank you very much for tuning in, and we look forward to being in touch again soon with many of you, no doubt. So thank you very much.
Perfect. Thank you very much indeed. And thank you for updating investors today as part of your roadshow. Could I ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback. If you access this meeting from our website, then the feedback page will appear. If you accessed it from the link sent you by email, you'll be asked to log back in to submit your feedback. So on behalf of the management team from MP Evans and Investor Meet Company, I'd like to thank you for attending today's session. That now concludes the presentation. Good afternoon.